give you an idea of who we are, St James's Place are probably one of the largest wealth management companies in the country now. We've just entered the FTSE 100, and people like Oliver is self-employed but has chosen to align his business with St James's Place. So we produce the investment vehicles, the pension vehicles, the fund management that Oliver can utilise for his clients. Okay? So that's Oliver, and that's me, and I'm a business development manager. It's a little bit, I'm not an IFA, unlike John. I work directly with St James's Place. I don't advise people. I haven't got the diploma, but I haven't got the up-to-date knowledge, or if you like, to go out and advise clients. So I'm not regulated in that way, whereas Oliver, John would be. I'm not. However, I do help businesses grow under the St James's Place banner. Okay. So what's happened in the budget? Impact on pension annuities. Just something fairly high level initially, and what's happened. Radical reform around pensions. Now the reason they've done this is because I'm not sure if anybody is aware. Does everybody know what an annuity is? Yep. So an annuity is something you buy at the end of your pension contributions, if you like. So you've got your pension pot, you go out and you buy an annuity. You can actually buy an annuity from whoever you like. However, because of the interest rates, those annuity rates are pretty horrible at the moment. So the government have looked at that and said, rather than force people down the annuity rate, potentially we'll give them the option to take all of their pension as and when they want. So you can take your tax-free lump sum, and then you can start drawing down on your pension. You can take as much or as little as you like. Okay? However, that's not tablets of stone yet. That's still in consultation with some of the industry giants, if you like, the Legal Generals, the Avivas, and also with HMRC. So that's what's happened, and it's all defined. There's a difference about defined contributions and defined benefits. Defined contributions are where you decide how much money you put into your pension each month. Defined benefits are if you're in a final salary scheme. Has anybody ever been in a final salary scheme when they were, yeah? Brilliant. Very, very hard to get now, final salary schemes, because they are so expensive to run, but if you've got one, brilliant. Oh, fantastic. Showing off there.
Unless you work for the government.
Sorry?
Unless you work for the government.
Unless you work for the government, of course, then you're in a defined benefits scheme, yeah. So, major relaxation around the rules of small pension pots, and I'll cover that in a little bit more detail. Reforms around ISAs. Does everybody know what an ISA is? Yeah? Individual savings account. It used to be that the maximum was 11,520. That's just gone up to £15,000 as from July, actually. So there's some other implications around ISAs as well that I'll quickly cover in a second. The tax rate on savings is reduced from 10% down to 0%. So your first £5,000 worth of savings, where you used to be taxed on it, is tax-free now. So something to bear in mind, particularly husband and wife. If you've got savings and you're a taxpayer, it's better to transfer those into his husband as a non-taxpayer or wife who's a non-taxpayer into their name. So really making sure that you utilise all the potential benefits around that. Okay? Personal allowance has gone up, which is good news. Up to £10,000 for 2014-15 and £10,500 for 2015-16. The bracket between higher rate and normal rate tax has changed slightly, but nominal. So that's good news for us, good news for anybody that's a taxpayer. If you're a part-time job, then it's a good idea to try and keep your income to £10,000 or £10,500 because obviously you're not going to be taxed on it. Okay? The tax allowance for married couples, £1,050, so you can transfer that again between husband and wife. Again, so if you're a stay-at-home husband, for example, and your wife is earning, she can transfer some of her tax benefit over to you, and vice versa. For businesses out there, this is quite an interesting one, the annual investment allowance. Does anybody know what the annual investment allowance is? Yep, excellent. I should expect the accountants to know. It's basically how much money you can invest in your business, so things that you can buy for your business that you can offset then against your tax bill. It used to be £15,000 years ago. In fact, years ago, say a few years ago. The new government changed that to £250,000. It's now increased to £500,000. So you can invest £500,000 in allowable capital, if you like, allowable things to bring into your business that you can then offset against your tax bill. Anything over £500,000, you can offset at 18%. So you can see it's a massive difference. For new businesses and smaller businesses starting up, it's a real boost that the government has given those individuals and those businesses. So it's something to bear in mind. Something to talk to your accountant about. We've got a couple of accountants, haven't we? Definitely something to talk to your accountant about. And then enterprise investment schemes and venture capital trusts sound really out there, don't they, and really risky and horrible, but they're not, funnily enough. In fact, there's some really good enterprise investment schemes out there that have had all the risk managed out of them that we utilise for our clients, because when you, for example, if you have 2 homes and you sell your second home, there's capital gains tax on that home, you can invest that money into a investment in EIS, Enterprise Investment Scheme, and you can offset the capital gains tax. There'll be no capital gains tax to pay. If you're a higher rate income taxpayer, for example, or you're overfunding on your pensions, then potentially, again, EIS is the vehicle for you to use, because the government will give you 30% of your contribution back. So invest £100,000, you get £30,000 back, as long as that's left in there for 3 years and they roll over. Also, there's after 2 years they come out of your estate. So really, really good investment vehicles. I don't want to talk about it too much, but again, if you want to speak to IFAs, if you want to speak to Oliver about that, again, great investment vehicles to start utilising now. So pensions. Pensions, there's all this, you can take all your money out, you can have all your money straight away. You can't yet. So these laws don't come into effect until 2015. Everything is still in consultation, the government with HMRC. The good news is, HMRC, if you're about to or have to take an annuity, you can postpone that until 2015, and that would probably be our recommendation, just to see what the new rules are. If you've just commuted a pension, you've just set up an annuity or just bought an annuity, the HMRC now said you can bring that back into your pension pot. So if you think, just taking out an annuity, really rubbish rates, have to do it though, you can bring that back into your pension pot, and there's no cost from HMRC, no tax implications, so you're allowed to do that. Again, it's only on defined contribution schemes, so not on defined benefit, not on final salary schemes, because defined final salary schemes, why wouldn't you take that final salary scheme, because they are excellent. So now there are several things that you can do. Has anybody heard of drawdown? Yeah. So again, drawdown was introduced because annuity rates are so low. So instead of taking or buying an annuity, you can go into drawdown, we call it. You can take your 25% tax-free lump sum, and then you can choose a flexible or a capped, depending on various litigations, drawdown. So you can, the government set an annuity rate called the GAD rate, where you can take a percentage of that GAD rate. So 120% has now increased to 150%. So when you were taking maybe 5% from an annuity, you can get 150% of that as an income when you draw down from your pension. Again, worth taking advice on. Or the flexible, what we call the flexible drawdown, where you had to have an income from other sources of £20,000 to be able to draw down from your pension pot. That's now reduced to £12,000. So again, it gives you an opportunity to access some of that money which you might not be able to get at. Or if you would have got it, it would be at pretty hideous annuity rates. So that's what you can do now. For the future, what they're talking about is introducing flexible drawdown for every defined contribution scheme out there. So in 2015, what will happen is that potentially Oliver, for example, if he had a pension pot of £100,000, he could take his 25% tax-free lump sum. The other £75,000 he can draw down whenever he wants, as much as he wants, and he'll be taxed at his nominal tax rate. So if Oliver was a 20% taxpayer, any money that he'd draw down out of his pension would be taxed at 20%. If he was a 40% taxpayer, any money that he'd draw down, he'd be taxed at 40%. If he wasn't a taxpayer, obviously he could draw that down up to the £10,000 limit for 2014-15 and not be taxed. Okay? The concern is, and this is what some of the industry are saying, is the concern is that individuals might take all their money as soon as they can, spend it all, and then be in a really bad situation. However, the argument back would be, well, there's more money into the economy, people tend to save their money, tend to spend it wisely. So if you have got a pot of £100,000 or £150,000, you're going to be fairly frugal with your money anyway and spend it wisely. If it's only 20 or 30,000, that money would be better served being drawn out straight away back into the economy. It could be paying off mortgages, it could be paying for cars in retirement, and you're going to live off the state pension or the final salary pension that you had in place anyway. So we're, as taxpayers, we're not going to be paying any more money for you or to you. Does that make sense? Yeah? In terms of small pots, pension pots, you only used to be able to take out £2,000, that's going to increase to 10. So what does that mean? So if, for example, I've been at a company for a couple of years and I built up 10 grand in my pension, and I want to take that money out, you can do. It used to be 2,000, it's now 10,000. You can actually take out, we call it the commutation lump sum, trivial commutation. It's a very small pension. You can take out up to 3 pensions now, up to the value of £30,000 if you wanted to. If you wanted to take that money and utilise it straight away, you can still be earning. You can still be. You don't have to be retired to do that. So that's the new regulation. That's gone from 18 to 30,000.